Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. U.S. Market Trading Review, July 24, 2026. This video presents a direct informational narration of the source document.
So, here's the structural roadmap for today. We'll be moving through 5 main sections: market core logic, the macro environment, index trends, stock specifics, and finally, a data fact check. Moving right into Section 1, market core logic. Specifically, we'll be looking at AI hardware and deleveraging.
Right now, the semiconductor sector is dealing with extreme weakness. The source document notes a major shift here. Focus is moving away from just order growth, and instead, there's a heavy anxiety around supply chain vulnerability. There's a real fear that downstream cloud giants are going to slash their capital expenditures. And, if that happens, it puts a hard ceiling on any upstream order growth. Which leads us straight into this concept of forced deleveraging. Basically, this is a mandatory strategic adjustment where capital is aggressively pulled out of high valuation option speculation and rotated back into the safety of underlying cash flow quality. The warning from the source here is clear: avoid short-term options and give the sector the buffer space it needs to find a bottom. Okay, on to Section 2, the macro environment. This covers tariffs, geopolitics, and inflation risks. Now, here's a massive number: 99.4%. According to the source, the new 10 to 12.5% tariff policy across 60 different trading partners covers 99.4% of U.S. imported goods. On the geopolitical front, we have a few key updates. Pakistan is reportedly exploring U.S.-Iran talks, and Netanyahu is visiting Washington next week. But contrasting with those updates, the U.S. Embassy in Israel issued a sudden escalation alert. And it was exactly that alert that actually triggered a Friday sell-off. To put these tensions into perspective, let's consider shipping costs. If a ship has to take a forced detour around Africa instead of the normal route through the Mandeb Strait, the transit time jumps from 19 days to 48 days. Fuel costs more than double, going from $1.26 million to $2.87 million. Plus, you have roughly $1 million in extra detour fees. So, what does this all mean? Well, those increased shipping costs are inevitably going to be passed straight down to consumers. The source concludes that this will sustain inflation and effectively restrict global central banks from easing monetary policy in the near term. Next up is Section 3, Index Trends Analysis. We'll examine key moving averages and psychological levels. Breaking down the index technicals, the S&P 500 was down 0.61% for the week and lost its 10-week moving average. The key line of defense to watch now is the 20-week moving average, sitting right around 7,200 points. Meanwhile, the Nasdaq is holding the bottom of a triangle pattern, finding support at its half-year line, the annual line, and 2025 highs. The source specifically cautions against buying the Nasdaq until that 5-day moving average is successfully recovered. Moving right along into Section 4, Stock Specifics, focusing on earnings and value reassessment. The source points out a really stark contrast between defense and vulnerability right now. On one side, you have Apple, acting as a safe haven and actively absorbing capital. On the other side, you've got McDonald's, which is down 23% and just broke its 200-week moving average. To put that into perspective, the document emphasizes that a 200-week moving average break has only happened 4 times in 20 years. Now, looking at Intel's financials, they reported a 59% spike in data center revenue, which sounds great, but that is contrasted by a negative $8.4 billion in adjusted free cash flow, alongside capital expenditures exceeding $20 billion. In the memory sector, Micron took an 8.75% drop. The source advises breaking this sector down a bit further. Traditional consumer DRAM is facing Q4 price pressure, but the high bandwidth memory and enterprise SSD segments are actually sustaining longer profit cycles. Checking in on a couple of other tech updates. Google is facing extreme geopolitical downside support levels at $300 down to $270. Then there's Oracle. They won a massive $7 billion Department of Defense contract, but lingering capital expenditure fears overshadowed that, pushing their support down to the $120 and $100 marks. A few additional stock movers listed in the document. Amcor signed a $1.5 billion packaging agreement with Daewoo. Digital Realty had a strong Q2 with revenue up 28.9% and EPS jumping 41.7% to $2.65.
and American Express maintained their full-year EPS guidance of $17.3 to $17.9.
All right, bringing us to our final section, Section 5, Data and Fact Check. This is the end of report verification checklist.
The source includes 5 specific verification items here. First, matching the S&P 500 20-week line at 7,200 points with July 2026 weekly lines. Second, confirming that after next year for Intel's foundry verification means 2027 and beyond. Third, verifying that the 99.4% tariff coverage includes all 60 partners. Fourth, re-verifying that the McDonald's 200-week break has only happened 4 times in 20 years. And fifth, verifying the official background of the source regarding the Pakistan-US-Iran talks.
Summarizing everything, the source document concludes that the U.S. market is currently in a severe deleveraging oscillation. It's actively pricing in downstream cash flow pressures alongside complex inflation expectations.
And the final recommendation from the document is to maintain extreme caution, reduce high leverage tools, and wait for upcoming tech earnings to establish new valuation benchmarks.